Good afternoon, everyone. Welcome to our fourth installment of Medicaid Mondays in March. We are the alliterative firm of Pierre O'Connor and Strauss. We love alliteration and acronyms. We're lawyers. And today's session is going to be on nursing home Medicaid. Just a little recap of what we've done in the prior sessions. Let me get that up for you. We did week one on just basic eligibility rules and how to qualify for Medicaid. Week two was Medicaid Asset Protection Trusts, the staple of the elder law practice, the trust that does asset protection and creates tremendous flexibility. And in week three, we covered both old and new rules for Medicaid home care. And if you're in the field, and I think many of you that are viewing today's webinar are in the field and doing work in elder care services and perhaps even in the Medicaid realm directly, home care is in a very, very interesting state of flux right now, where we had rules that changed 2 years ago that were suspended due to COVID and the federal regulation that prohibited New York from putting more restrictive rules in. Those are now being implemented, and we had the first wave of these rules come in October 1st of 2020, when any transfer at that point would be subject to a look-back period. When the look-back period becomes effective, then November 8th is when the 60-day comment period was up and a certain amount of rules went into effect then. And now we have another much more significant set of rules coming in with the independent assessor and all the independent physicians May 1st. And we believe we're going to get the look-back period of 2.5 years on July 1st, although that still is not definitive. So today's session on nursing home Medicaid, many of these rules will be applicable to Medicaid home care once the look-back and penalty rules go into effect. There are also some very interesting things in the state budget, the governor's budget, and the one House bills that affect Medicaid and Medicaid eligibility. So we're going to keep a close eye on those. And we're going to talk at the end about our Elder Law Forum, which comes up in May 19th. And at the Elder Law Forum, we will have Valerie Bogart doing a full explanation of the current state of affairs of all of these rules, along with Adam Herbst from the New York State Department of Health, Greg Olson from the New York State Office for Aging, a few legislators who are going to join us. And so we hope that you can join us on May 19th as well for a much more in-depth look at where these rules are going. This is our firm, Pierre O'Connor and Strauss. We are based in Latham or Albany, New York. We have a Manhattan office with a number of attorneys, paralegals, and staff. We work throughout New York State. So I know many of you are from across the state, from as far away as Buffalo and down to Staten Island and out to Nassau and Suffolk counties. So welcome to today's webinar. And we do service most of that catchment area. So we're a firm that does pretty much statewide elder law, Medicaid, trust and estates, and estate planning. And the agenda for today, steps you can take now if you want to plan ahead for Medicaid. We always have to look at the numbers because Medicaid is a very detailed numbers-driven program. Exempt assets, exempt transfers, we've had these rules for quite a while. The rule of halves, and some issues with regard to nursing home admissions, nursing home discharges, and many of the issues that our clients face in going in and out of nursing homes for rehabilitation, permanent placements, transitions back home. We'll look at some of those issues toward the end. And Frank, Medicaid is a program that's divided into two very distinct programs. And why don't you just walk our viewers through these two?
Sure. So whenever we typically talk about Medicaid, we have to talk about which one are we talking about? Home care or community-based care, or chronic care or nursing home care. So in last week's webinar episode, when we went through the new rules that are coming to community benefits and an independent assessor and all those changes, that was focusing on that community side of things, where we look at home health care, assisted living coverage, things like adult daycare services. That's where we're not seeing a current look back period because of the pandemic, just like we went through before. So now today we're going to the other side, to the left-hand side of your screen, over to chronic care. In some ways, this is easier to explain because these rules have been this way for quite some time, and we're going to continue to do all the stuff we're going to go through here until they change these rules on this if they wind up doing something like that. So the biggest thing with chronic care Medicaid is there's a 5-year look back period. It's been that way since 2006. So whenever we deal with crisis planning, nursing home planning and stuff, that's when we have the 5-year look back period that everyone gets afraid of when they hear Medicaid.
Mhm.
There will be a look back period in place for home care once the pandemic is lifted, going up to 2.5 years as we went through last week. But for now, the look back is here, has been here, will continue to be here for nursing home benefits.
And the corollary to the 2.5-year look back is if you apply for Medicaid home care today, there is no look back. You can transfer assets today on March 28th and be eligible for Medicaid home care benefits on April 1st. Critical for those people who may need home health care in the near future. Try to get the application filed, try to find a hook to get eligibility and get grandfathered in under the existing rules. And we are pushing out Medicaid home care applications as fast as we can. And for those clients that are on the cusp, we have people that can do a very thorough assessment to determine the medical eligibility. We can always deal with the financial eligibility, but it's the medical eligibility. Do you qualify for benefits? Will you meet that first test, which is the Maximus test right now, the conflict-free assessment to get into the long-term care program. And once you are, then you get assessed for the number of hours. But if you're on the cusp or you know people on the cusp, you have clients or constituents on the cusp, filing now gives them a tremendous advantage. So we recommend that they consider it and get an assessment done to determine eligibility under the current rules before these new rules go into effect. So we have seen the cost of care escalate tremendously. I started practicing 38 years ago, and the cost of nursing home care was a few $1,000s a month. Some people could afford that at the time, but it wasn't nearly the game that it is today. And Frank, we have clients coming in every day talking about the cost, and they get that first bill, and the costs statewide have escalated. And right here in our own capital region, they've gone up dramatically.
Yeah, I mean, as you can see on the slide, that $15,000-$16,000 a month for the Albany area, that's what we're seeing. And it doesn't have to be the nicest facility or even the middle of the road facility. If you're going from the nicest to the worst, and it's not saying who is who in that scenario, that bill is still going to be roughly between $15,000-$16,000, especially when you put the 6.8% surcharge tax on top of the daily rate going for room and board at a facility. And this is the kind of thing that unfortunately there are just many, many, many people, unfortunately, that are under the assumption that their existing healthcare coverage, whether that's Medicare or their Medicare supplement, are going to help pick up these bills. And unfortunately, that just isn't true. That's why we talk about Medicaid, because as we've said in these past webinars, there's only a few different payment sources for this, right? One is out of your pocket. Another is long-term care insurance. And if either of those things can't get you where you need to go and pay those bills, then the third and last option is Medicaid, because not many people can stomach $15,000-$16,000 a month very long without it severely impacting their finances.
Right. Most people, when they enter a nursing home, are impoverished within 24 months, meaning they've spent down all of their worldly possessions, all their worldly assets within a 24-month period. There are people, obviously, that have much greater resources and wealth than that, and they can maybe self-insure at $200,000 a year, but most people cannot. The vast majority of people cannot. So that's an eye-opener when we have clients come in, they just wrote the first check for the first month in the deposit, and they wrote $32,000 check just to get mom or dad into the nursing home. And that's a big shock for a lot of clients.
Sure. It's not uncommon where a facility will want their current month room and board, and then they'll want the following month just to make sure that they know where that payment is coming from. So if you're taking 15, 16,000 times the current month and next month, that's a $30,000, $32,000 plus check that you're writing just for a very small amount of time.
So because New York is a very diverse state, from Buffalo to Long Island to Staten Island up to Plattsburgh, costs are very different. And New York is broken down into regions. There are regions all across New York that we're going to talk about. But at the end of the day, these numbers, the numbers we're going to talk about now, are the same whether you're in New York City or in Plattsburgh or in Syracuse or Buffalo or Albany. The eligibility numbers are the same.
Sure. So the biggest ones on this chart to focus on today would be one that actually isn't even here. And that's the income allowance for someone in the nursing home receiving Medicaid. That's an easy one. It's been the same number since the 60s. So if you're one person in a nursing home getting Medicaid benefits, your income allowance is $50 a month. That's it. No questions asked. There's no pooled trust here. There's no real games to play here. It's $50 a month. All right. If you have a spouse in the community, the spouse in the community can have their own income or a shift of their spouses to bring them up to $3,435, that minimum monthly maintenance needs allowance number. That's the third one down on that top income set of numbers. Your assets or your resources, those are the same numbers we've been talking about. Those stay the same regardless of whether you're at home or in a nursing home. So if you're one person in a nursing home, your asset limit is $16,800. Weirdly enough, if you have a couple, and we actually just had a case like this recently where we had mom and dad in the same facility, they're not treated as a couple because they're not both at home as the brackets say over there on that left-hand side. So if you have mom and dad in the same facility, they both get their individual allowance of $16,800. So you get just over $32,000 between the two of them. That's a little strange because home care doesn't work that way. But if you have only one in the nursing home, one person, one spouse in the community, then they have that community spouse resource allowance up to $74,820 or the greater spousal share up to $137,400, as we've talked about before.
And knowing these numbers, more importantly, how to navigate these numbers is critical at the point in time when you're thinking about Medicaid, planning for it, or if you're at the point in time of application. And it is very detailed. The devil is always in the details. And when you do a Medicaid application, as we're going to talk about, you have to bring the numbers. You got to bring all the paper, every canceled check. You've got to bring in statements for 60 months. So it's somewhat of an onerous burden to apply and to have all of that done correctly. Certain things, Frank, are exempt.
Yeah, you have your $16,800 allowance, right? So you can have any amount of assets up to that point. So that could be cash value of life insurance, it could be bank accounts, it could be stocks, anything that, as long as it's combined with your other assets that count, are below or up to $16,800, those are exempt. One automobile. Now, if you notice, there's no value here because the rules, weirdly enough, don't put a value on the value of the car. So you can have one car regardless of its value and be in the nursing home and have it be an exempt asset. And you can look at it outside of your nursing home window, even if you'll never drive it again, but you're allowed to have one as long as you only have one. If you have a second vehicle, the value of the second vehicle will count as an asset and go towards that $16,800 number. Another big one that we constantly speak to clients about, even though it's not a fun subject, is that prepaid burial and funeral arrangement, right? If you haven't prepaid for those services and you have to spend some money, you might as well get some bang for your buck. Do that planning in advance, because we don't want something to happen where then someone passes away and now there are insufficient funds to pay for those burial funeral arrangements. So a lot of times when we need to make money disappear for Medicaid purposes, that's another avenue we use, is to prepay that burial and those funeral services.
And sometimes clients want to do that early on, but it may not be the best thing to do it right away, Frank. Maybe best to put that expense off a little bit.
Yeah, it all kind of depends on just where we're at and what kind of scenario we're dealing with, because sometimes it's easy to know we might get down after some other things are paid for. Maybe you want to buy that new car. Maybe you have some outstanding bills you got to pay off. You might have some legal expenses to pay for. If we get everything else taken care of and we're just a little bit over that $16,800, that's the perfect avenue to use that burial for, because then we know how much we need to spend on that burial and funeral to get you down below the allowance number, and then we'll get you on Medicaid ASAP, and we'll have very limited funds, if any, going back to the nursing home.
Some other exempt assets include the home. If you have a spouse living in the home or a minor or disabled child living in the home maintains an exemption. There are also ways that you can gift the home without a penalty, without that transfer penalty that we're going to talk about next, to someone called a caregiver child who's lived with the parent for 2 years and provided services that have kept them out of a nursing home. And it has to be a child to qualify for that exemption. A sibling, brother, sister with an equity interest in the home. And to a spouse, you can always transfer it to a spouse. So you have an ability to transfer the home under those limited circumstances without penalty. Any other time you transfer the home, it would incur a penalty. But when you're going into the nursing home, you don't have time to plan and transfer the home. There is a way that you can file something called an intent to return home. And the law in this came from a federal case a number of years ago, and it's a subjective intent. So you don't have to have a realistic expectation of going home, simply a subjective intent to go home. And that will take the house off the table for immediate eligibility consideration. But then you have liens and recoveries, which we don't have time to really dig into today, but Medicaid can come back against the estate, but only the probate estate.
Correct. So the biggest thing here is that usually what happens is we get the Medicaid spouse taken care of, get them approved. And then as soon as we have that approval, then there are some usual additional planning steps that we want to use. Then to get that house out of the name of the spouse or even the minor or disabled child, just depending on what's going on, because we don't want things flowing through someone's estate when they pass, because we don't want Medicaid to reclaim against that estate.
Some other lesser known exemptions, a business. A person can own an active business, income producing business. We sometimes have clients with rental properties that we wrap into a limited liability company and operate it as a business. And if it's income producing, it can be an exempt asset for Medicaid purposes. I did a talk on this for the National Academy of Elder Law Attorneys 2 years ago. So if you're interested, I have an outline. I'd be happy to share with you on how that exemption works for a business or income producing properties. Also life insurance, but only a face value of $1,500, so not a whole lot. 1965, that was enough to get buried, not so much anymore. The other one that's a major exemption is retirement accounts. So if you have an IRA, 401k, regardless of value, that is in periodic payment status, which means that you're withdrawing. And the questions that come up, can you take it out before age 70 and a half? The answer is yes. You can start periodic payments prior to 70 and a half. Can you do it with a Roth? Because there really is no required distribution from a Roth. So far, so good. They will honor the distributions. So it's a careful calculation. You have to use the tables applicable to IRAs. And some counties use different tables, and you run into that, Nassau County being one. I've litigated there. But this is a major asset that people can hold on to. Even if they're in a nursing home, that asset is exempt as long as it's being distributed with periodic payments. So those are our exempt assets. Everything else is non-exempt. And if we gift anything, there is a look back of 5 years and a penalty period within that look back. Some exceptions to the transfer rules, transfers to a spouse or disabled child. I mentioned the transfer of a home to certain beneficiaries, but even these kinds of innocent gifts to a church or a grandchild are going to be aggregated if they're within the 5-year look back period. And there it is, looking back 5 years from the date of application. And when you do, it has a whole set of ramifications.
Yes. So the biggest thing to know, just in general, right, is just know the consequence of making gifts. And remember, gifts are not necessarily what you think of when you hear the word gift. Gift here means that you give something away for the benefit of somebody other than yourself for nothing in return. Right? Did you pay for that grandkid for college? Did you buy someone that car? Did you give your car away to somebody because you weren't going to be using it anymore?
Or sold it to them for $1, in which case it's a $1 sale and a $10,000 gift.
Right.
Any uncompensated transfer is going to generate something called a penalty period. I mentioned that across New York State, there are different regional rates. This is the chart. It's in your slides. So you can look up where you are located in New York State to see what your divisor is. But here's how the divisor works. You aggregate everything that's found within that 5-year period. We do the audit pre-application. So we have a paralegal that goes through every record, every bank statement, every brokerage statement, and audits that before we apply for Medicaid, so we don't get unintended consequences. And you add up the value of all the transfers and you divide it by that divisor number. This is the formula for the penalty. The second period in Medicaid, look back period is the first, penalty period is the second. And you apply a penalty period if you are applying for Medicaid and you have transferred assets within the 5-year time period. You have to be otherwise eligible for this to even run, meaning you're below $16,800, and then you file your Medicaid application. So in this case, we have gifts of $150,000 and change over the last 5 years. We are down to $16,800. We apply for Medicaid. We now have assessed against us a 12-month penalty period, but we only have $16,000 left. So Frank, the next question is, who pays?
Well, we have a problem now, right? Because now we have a person that's sitting in a facility where Medicaid's not paying for them. So at best, they can pay over that 16,800 or whatever's in their bank accounts, just to give the nursing home something. Obviously, the nursing home would be entitled to their monthly income coming in. But other than that, there are no funds to give the nursing home. So what typically happens, and I believe I said this maybe even last week on our webinar, is it's not uncommon for that facility that at any time that person starts to have some medical issues or any other reason why they can transfer them to the hospital or just out of their facility, they're going to look into pursuing that avenue, getting that person out of their facility. And then once they're gone, giving that bed away to somebody who can pay, whether that's a private pay person or another person that's been approved for Medicaid without a period of ineligibility made against them.
So when we're guiding our clients through the Medicaid application process, first thing we want to look for are exempt assets and take those and make sure those are safeguarded off the table, sometimes take steps to protect the home. And we want to also then look for possibilities for exempt transfers, spouse to spouse being one, disabled children. It's a major exception. And we've had this pop up at the 11th hour. People were doing rule of halves transfers and all of a sudden they said, oh, and my one child has a disability. Well, you can transfer all the assets to the disabled child or a trust for the disabled child, and it is exempt for Medicaid purposes, no waiting period, even though the transfer is within the 5 years. But for those transfers, Frank, that we get to that are not exempt transfers and not spend down items, so not prepaid funeral and burial, not legal expenses, not buying things, what happens?
So generally what happens is we have that penalty period, right? That's why we don't want to make those gifts. So instead, what we try to do is we try to put a plan together to deal with somebody who's in a scenario where they haven't done their plan in advance. Now they're coming to us at the 11th hour. They need that nursing home. They have all these assets built up in their name. There's no easy way to get rid of them. There's no spouse to give it to. There's no disabled child to give it to. There are no outstanding bills we can use or other expenses that can be made. And we then come up with essentially what we call our crisis plan. And we use something called a rule of halves or a gift and promise or plan, where essentially we are able to save just about 50% of what's around.
So let's take a look at some numbers, Frank.
Sure. So I'm going to do my best to make this make sense, right? This is a lot of numbers, so we're going to try to keep it simple without throwing too many at you, but unfortunately, that's kind of just the nature of the beast. So Bob comes to us. He's got about $3,500 a month of income, and he's got about $350,000 worth of assets. Unfortunately, he's already made some gifts in the past 5 years for $100,000, so we're already aware of that. He's currently in a nursing home, and his cost is right around that rate that we said right at the start, right? $16,000 a month. So in conjunction with us, his family starts doing some things for him. They buy him some television, some clothes, some furniture. He has to pay some legal expenses for our assistance with all this stuff, and essentially we're able to spend down about $34,000.
We call it the shopping spree.
Yeah, go shopping.
So whatever you need to buy for the rest of your life, literally buy prior to filing a Medicaid application, as long as you're getting full value for the purchase. It's not a transfer, it's not a gift. It has to be used for you. So there was a Medicaid application case where someone with a power of attorney went out and bought 5 television sets. Well, you can't put 5 television sets in a nursing home room. So they flagged it as a transfer for other than full consideration, and rightly so. So do it carefully, but you can spend money, and decent money. If the home is exempt, you've got a spouse living there, you can put money into the home. We do home repairs all the time. Fix the roof, fix the sidewalk, put a new kitchen in even. And those are expenses into an exempt asset if you have someone living there that exempts the home. All of those things go into the calculus, but then at the end of the day, you've got to come up with enough money to pay the nursing home while the penalty period that you've now generated runs.
Sure. So just to finish this one off, right? So after we spend those things down on Bob, on those legitimate expenses, now we're down, with about $300,000 plus his exemption. And we're going to have Bob gift an additional $100,000 to that Medicaid Asset Protection Trust that Lou and Aaron discussed in week 2 of our Medicaid Mondays. And then we're going to loan the other half of the money, the other $200,000 to his son. And if we made all that transferring happen today, then we'd essentially have him teed up to have all this start with the clocks ticking for Medicaid purposes as of April 1st, which would be the end of the week. So just to kind of just do a quick recap of what have we done, right? We looked at that nursing home cost of $16,000. We had to factor in his monthly income, right? His income was $34.90 a month. We have to take out his $50 allowance. So between what his cost is, and taking out his income, he's shortfalling $12,560 a month. And then we spent down some of his assets on those legal plan and that television and the burial and all that stuff. So essentially, at the end of the day, we've got a shortfall of about $12,560 of income, and he's got assets that are at risk of $300,000.
And
So then we make our gifts and our transfers. And essentially what we've done is we've gifted away $200,000. So that would be our 100,000 now plus the past 100,000. And if you plug that into our calculation and our penalty numbers, if you give away $200,000 with the current numbers, that results in, let's call it a 16-month penalty. It's 15.92 months of penalty. But then that other second half of his money, we had a loan, right? We had to get that away from him. You can't apply for Medicaid if you've got $200,000 in your name. You can only have 16,800 or less. So there's laws on the books that say if you structure your loan properly, which we clearly would do, that when you transfer a payment away as a loan with the promise to repay once a month for the lifetime of the loan, it's not counted as a transfer. So the loan here, wouldn't you know it, we've loaned away $200,000 with the promise to repay $12,560 a month for 16 months. So if you look here and just quickly just look at the numbers, we've created a penalty for 16 months because we gave away $200,000. And the second $200,000 that he has is going to pay for that period of ineligibility for the exact same amount of time, that 16-month penalty period. We then apply to get all this rolling April 1st because we made those transfers today in our example. And then Medicaid is on hold while that penalty runs between April 1st, 2022 and the end of July next year. Once we get to August 1st of next year, Medicaid will pick up. Bob will be on Medicaid for the remainder of his life with that income payment being made to them, but nothing else.
And what have we done?
We've saved him quite a bit of money. We saved him the 100,000 that went to the trust now. We also saved the 100,000 he already gave away previous. We also kept his assets up to that $16,800 allowance. We had him prepay for those stuff. And then we also had him buy some personal items, right? That television, that furniture. And going forward from 8/1/23, Medicaid would pay. And then everything that we've saved is now off the table from Medicaid. That's sitting with Bob in his trust for his family's benefit.
So there are other rules that play in. You can gift assets back and remove the penalty period. You can argue that the transfer was for purposes exclusively other than to qualify for Medicaid, which requires a hearing to do that. So there are other rules that can be brought in, but this is the basic eligibility calculation for someone who wants to save some assets, private pay the nursing home during that interim time period, and qualify for Medicaid on the exact day that they need it. Quickly, with regard to married couples, spousal refusal is something that is still in play. So you can transfer all the assets from the healthy from the sick spouse to the healthy spouse, and the healthy spouse can sign a spousal refusal that's missed in the governor's budget 27 years in a row. They've tried to eliminate it. It is still there. There are also allowances that Frank mentioned, the minimum monthly maintenance needs allowance and the community spouse resource allowance. So the spouse at home with one spouse in the nursing home actually does a lot better than a spouse at home with the other spouse living with them at home. So it's a very perverse incentive to place someone in a nursing home to make the well spouse's life better financially. But the MMM&A is something you can also go and seek to increase if you can show the needs of the well spouse are greater than $3,435 per month. You can also seek to increase the resource allowance above the $74,820 if you need assets to produce that income for the community spouse. We used to do a lot of those hearings, but the rules are not as favorable as they used to be. So these are less common, but spousal refusal is still very, very common. Transfer to the well spouse, apply for Medicaid for the ill spouse. It's not the end of the game because you will get Medicaid eligibility immediately. So the spouse in the nursing home goes on Medicaid day one. No questions asked, but then there is a right of recovery. So the Medicaid applicant assigns over their duty or the rights of spousal support to the other spouse and to the social service agency, and DSS in New York State can pursue the spouse with the money and seek contribution toward the cost of care. We haven't seen many of these suits lately, but doesn't mean they won't come back. and with a vengeance if you have spouses with significant assets in the community. But right now, the counties just don't, I think, have the resources to pursue spousal refusals. But we do it, we still use it. What we do once the spouse goes on Medicaid then is what we call post-eligibility planning. So the well spouse, once the spouse in the nursing home is approved for Medicaid, creates a trust and can then transfer the assets into a Medicaid asset protection trust for his or her own planning purposes. And we want to avoid these. So we want to get out 5 years in advance, obviously, Frank.
Yes.
So the Medicaid Asset Protection Trust is the best way to do that. And again, session 2 was on the Medicaid Asset Protection Trust. It's available on our website at purolaw.com. And all of this leads us to the question, do you need a lawyer in a law firm to file a Medicaid application? I think if you look at how complex these rules are and all of the exceptions to the exceptions to the exceptions to the general rules, you need to at least get counsel and advice from an attorney to go through this process. Clearly, if somebody has no income and no assets, filing for Medicaid is a very simple process. There's no look back, there's no penalties, they don't have any considerations. But for anyone that has assets, that has issues, that has a home or a retirement account, or wants to protect income, or has a spouse or a disabled child, you really need to consult with a qualified law firm in order to file a Medicaid application. And we're here if you need us to do that. And we're very happy to work with you and your clients. And I mentioned earlier the Elder Law Forum, where it's more of a policy discussion as opposed to the nuts and bolts that we just did. But it is going to cover a lot of the Medicaid changes, the home care changes, the governor's budget, the legislative budget. And we'll see where we are on May 19th, where you're supposed to have a budget by then. And we'll know more at that point in time. So for social workers, you can get 6 hours of continuing education credit. It is a great program. Last year, we had about 800 people attend virtually. This year, it's going to be both live, so you can come see us at the Desmond, and virtual. So you can attend at home if you're across New York State, wherever you are, or you can make a trip to Albany and be with us to schmooze at the breaks and do some networking. And if you want to sponsor this event, we're also open to sponsorship. So contact Beth Wortman if you're interested in playing a role in this year's Elder Law Forum. We look forward to it. It's our 27th annual, and we just enjoy it and all the people that we meet there. So if you want to contact us, info@purolaw.com. There's our phone number. We do meet. Our office has changed. We just moved into a new office in New York City at 260 Madison Avenue. If you're here in British American in Latham, and we'll meet. We have offices across the state, Massachusetts, New Jersey, Florida. So we're very happy to work with you and your clients in the Medicaid process.